What if I told you about a company that just deliberately severed nearly half of its own revenue?
I mean, that sounds like literal corporate suicide.
Right. And on top of that, they are currently bleeding well over $100 million a year.
Mm.
Oh, and their top executives are aggressively dumping their personal shares.
Yeah, if you heard those stats in a vacuum, you would just assume the company is spiraling straight toward bankruptcy.
Exactly. You'd think it's game over. And yet, over the last 12 months, this specific stock has surged a staggering 438%.
Which is just, it's an absolute paradox.
It really is. So for everyone listening, you have to ask yourself, are you looking at a visionary tech pioneer that is about to completely corner the next generation of artificial intelligence? Or are you staring straight into an overvalued trap that's flashing some of the most severe sell signals in the entire market?
It's the ultimate psychological warfare for an investor. I mean, when a stock goes on a run of that magnitude, you get this intense fear of missing out.
Well, the FOMO is real.
Right, but it's battling constantly against the very rational fear of holding the bag when the music finally stops.
And that is the exact tension surrounding Navitas Semiconductor as we look at the landscape in mid-April 2026, ticker symbol NVTS.
It's a fascinating one to look at right now.
It really is. So today, our mission for this deep dive is to tear into the mechanics of this paradox. We are looking at a stack of sources. We've got raw financial statements, technical trading charts, insider trading logs, and the latest analyst ratings.
All the pieces of the puzzle.
Exactly. We are going to stitch all of these pieces together to understand the incredibly volatile transition phase this company is navigating right now. Okay, let's unpack this. What exactly is driving such an unprecedented swing in valuation?
Well, the volatility you're seeing isn't just, standard market turbulence. It's a direct symptom of a fundamental corporate mutation.
Mutation, I like that word for this.
Yeah, because Navitas isn't just launching a new product line. They are systematically altering their corporate DNA. I mean, for years, their bread and butter was the mobile market.
Right, like phone chargers.
Exactly. If you bought a high-end, super fast charger for your smartphone, there was a very good chance their chips were inside it. But here's the problem with mobile chargers.
They're cheap.
They are a totally commoditized market. You are fighting tooth and nail over actual pennies in profit margin.
So they just decided to walk away.
Basically, yes. Navitas is currently executing an aggressive pivot. They are abandoning those low-margin consumer electronics to chase the ultimate holy grail, which is the incredibly lucrative, high-power AI data center and electric vehicle markets.
Where the profit margins aren't measured in pennies, but in, like, thousands of dollars.
Exactly. Thousands of dollars per unit.
Which perfectly explains the absolute roller coaster we have seen on the charts over the past year. Let's talk about the 52-week range, because it is essentially a timeline of market sentiment.
Why?
We are talking about a basement low of $1.67.
Total despair.
Right, which represents absolute market despair. And then it shoots all the way up to a dizzying $17.79.
Fueled entirely by the euphoria surrounding the AI boom.
Exactly. And recently, as of mid-April, it has settled into this sort of, I don't know, like a hangover phase. It's hovering around $10.26.
A hangover phase is a great way to put it.
To me, this strategic pivot feels a lot like tearing down your modest rent-paying duplex to build a luxury skyscraper. You've intentionally stopped collecting rent from your old tenants. Your construction costs are absolutely astronomical right now, and you are just praying the luxury buyers actually show up before your construction loan runs dry.
That is a phenomenal way to frame the risk.
Right. Like, how does a company survive that kind of vulnerability without collapsing under its own weight?
Well, you are deliberately cutting off your primary source of cash flow, your mobile revenue, before the foundation of your new AI skyscraper is even poured. So, to survive a transition that violent, management has to accomplish two incredibly difficult tasks simultaneously. First, they have to maintain a flawless, compelling narrative to keep the capital markets willing to fund them. And second, they need an ironclad balance sheet to survive the actual cash burn rate.
It's a brutal waiting game.
It really is. But if we connect this to the bigger picture, you cannot assess the viability of a skyscraper project just by looking at the artist's renderings.
You have to audit the actual capital flow.
Exactly. We have to strip away the AI narrative and look at the stark reality of their income statement.
Let's do that, because the income statement paints a picture that is genuinely terrifying if you're only looking at the top-line numbers.
It's not pretty.
Not at all. Revenue for fiscal year 2025 dropped by a severe 45% year over year. They brought in just $45.92 million.
Yeah, almost cutting their revenue in half.
Now, as we just established, that steep drop isn't an accident. It's the strategic amputation of that mobile division. But it is still a massive shock to the system.
It's an amputation, yes, and the bottom line reflects the staggering medical bill for that procedure. I mean, the trailing 12-month net income is sitting at a steep loss of negative $116.95 million.
Ouch.
Yeah, and if we zoom in specifically on the fourth quarter of 2025, they posted an operating loss of $41.4 million.
In a single quarter.
In a single quarter. Though it is worth pointing out that a large portion of that includes restructuring charges.
Okay, so that's essentially the literal financial cost of firing the old teams, writing off the old inventory, and, outfitting the new AI-focused facilities.
Right. They have completely dismantled the duplex.
But here is the twist that keeps the optimists on board. When you flip over to their balance sheet, it is surprisingly robust. They are not currently gasping for air at all.
No, they have a solid cushion.
Total assets are sitting at $500.47 million against a very manageable $56.81 million in liabilities. And their cash position is remarkably strong at $236.9 million.
That cash position is the only reason they are still in the game. And we really need to talk about how they got it.
Right, because they didn't earn it from selling phone chargers.
Exactly. A significant chunk of that war chest came from a $95.6 million private placement they secured in late 2025.
And a private placement means they went directly to major institutional investors and sold them equity in the company, bypassing the public markets completely.
Right, and that is a critical signal. It shows that there are heavy hitters in the financial world who believe in this pivot enough to hand over nearly $100 million.
Wow.
Yeah, it ensures Navitas has the runway to fund this transition without taking on crippling debt. And management is now openly projecting that through aggressive cost reductions, they will hit positive EBITDA, meaning operational profitability, by the end of 2026.
Wait, hold on. I have to push back on this narrative of financial safety.
Okay, let's hear it.
You are praising this $236 million war chest, but you literally just told me they burned over $40 million in a single quarter. Do the math on that.
It goes fast.
If this AI pivot hits a snag, or EV adoption slows down, and this transition gets delayed by even 18 months, that entire war chest is completely vaporized.
That is a very real possibility.
Furthermore, let's talk about how the market is valuing that rapidly shrinking runway. The price-to-sales ratio for Navitas right now is 40.9.
That is steep.
Let me contextualize that for you, for the listener. The semiconductor industry average price-to-sales ratio is roughly 5.2. Navitas is trading at almost 41 times its revenue.
It's massive.
If you wanted to buy a local coffee shop that brought in $100,000 a year in revenue, you would never hand the owner $4 million for it, especially while the shop was actively losing money every single month. Isn't this valuation just blindly pricing in a utopian future that has zero guarantee of materializing?
That is the exact dilemma facing anyone holding this stock today. A price-to-sales ratio of nearly 41 for a business that just posted a 45% revenue decline is the literal definition of being priced for perfection.
Yeah, price for perfection.
The public markets are not valuing Navitas based on what the company is actually worth today. They are valuing it entirely on a speculative assumption. They are assuming Navitas will inevitably become a monopoly player in the data center hardware space tomorrow.
Well, here's where it gets really interesting. Because if you want to know what a company is truly worth, look at what the people inside the building are doing with their own money.
Always follow the money.
Always. And when you audit the insider trading logs, we are seeing some glaring red flags. We're talking about aggressive executive selling.
Very aggressive.
In March of 2026 alone, former CFO Todd Glickman dumped over $4 million in stock. And Director Ranbir Singh sold $3.7 million in shares.
Analyzing insider selling during a corporate pivot is absolutely vital. I mean, executives will often sell shares for benign reasons.
Right, like they have tax obligations or they just need to diversify their personal wealth.
Exactly. But when you see multiple executives cashing out over $7.7 million in a single month, while the stock is trading at a 41 times premium, It tells a different story.
It definitely raises an eyebrow.
These are the individuals with intimate, unrestricted access to the company's true operational health. If they believed this AI pivot was guaranteed to double the stock price by next year, they would likely be holding those shares, not liquidating them.
Exactly. It creates this fascinating and honestly somewhat tragic split in market psychology. On one side, you have retail traders, regular people managing their own portfolios, rushing in to buy the stock purely on the thematic hype.
The AI buzzwords.
Right. They see a headline that says Navitas is partnering with NVIDIA, they hear the buzzwords, and they blindly hit the buy button.
But meanwhile, the early institutional adopters and the executives who are supposedly building this future are quietly taking their chips off the table and heading for the exits.
It feels like retail investors are walking blindly into a classic value trap.
The professional analyst community is actively reflecting that exact anxiety. When you aggregate the consensus ratings among the 8 major analysts covering the stock, they are firmly parked in the neutral to hold territory.
What are the exact numbers on that?
You currently have 2 buy ratings, 5 holds, and 1 outright sell rating.
And if you're holding this stock at $10 right now, the analyst price targets are going to give you absolute whiplash. The average price target sits at $8.15.
Which implies roughly a 20% downside from current levels.
Yeah. And simply, Wall Street aligns perfectly with that, pegging their fair value estimate right at $8.15. But then you look at alpha spread.
Oh, alpha spread is brutal on this one.
Alpha spread completely strips away the AI hype and looks purely at the discounted cash flow and fundamental earnings. Their model places the intrinsic value of Navitas all the way down at $2.72.
That $2 figure is a sobering reminder of the underlying mechanics of the business.
It really is.
When you remove the futuristic narrative and focus strictly on what the company earns today versus what it spends today, it becomes mathematically agonizing to justify a $10 share price.
So the insiders clearly don't trust this valuation, and the fundamental analysts are ringing alarm bells. But insiders and fundamental purists aren't the only ones moving the market.
No, you have a massive army of momentum traders out there too.
Right. If we look at the daily trading volume in the technical charts, we can actually see where the broader market is drawing its battle lines. So what is the technical analysis telling us right now?
Well, the current technical picture is the textbook definition of buyer exhaustion. Let's look at the momentum. The macro long-term trend, the one that carried the stock up 400%, is still technically intact.
Okay, so the long-term chart isn't broken.
Right. But the short-term momentum, the energy actually driving daily price action, has severely cooled off since the peak hype wave we saw during the NVIDIA GTC 2026 conference earlier in the year.
Let's translate some of these specific technical signals for you, because it isn't completely bearish yet. The stock is currently trading above both its 50-day simple moving average, which sits at $8.98.
And its 200-day simple moving average at $8.53.
Right. Now, you shouldn't view moving averages just as random lines on a chart. Think of them as psychological floors.
That's a great way to put it.
That 200-day average at 853 is the exact price point where institutional buyers, the ones who still believe in the long-term AI narrative, are actively stepping in to catch the falling knife. Staying above that floor is a crucial sign of underlying strength.
It is the safety net, absolutely. We also look at the MCD, the moving average convergence divergence.
Which measures the relationship between two moving averages to gauge the speed of a trend, right?
Exactly. Right now, it is sitting at 0.179. That is technically a positive signal, confirming that the longer-term trend still has a pulse.
But you have to contrast that with the Relative Strength Index, or RSI.
Yeah, the RSI essentially measures how stretched the market's rubber band is. Right now, it sits at 62.06.
Which is technically categorized as neutral, right?
Neutral, yes, but it is creeping dangerously close to overbought territory. What that means in practical terms is that the aggressive buyers who pushed the price up to $10 are running out of capital.
The rubber band is stretched tight.
Exactly. And there are very few new buyers left at this price level to keep pushing it higher.
So if you are actively trading this or looking for an entry point, what are the specific levels you need to watch? The charts show a very fortified wall of support between $8.54 and $8.56.
That is the trench the bulls are defending.
But on the flip side, every time the stock tries to break out and push higher, an army of sellers steps in. There is major overhead resistance looming at $10.57, and an even tougher ceiling at $11.63.
When you synthesize the moving averages, the stretched RSI, and those resistance levels, the short-term outlook becomes very clear.
Which is?
The market psychology is shifting from aggressive accumulation to strategic profit-taking. The order flow models currently suggest that unless a new explosive catalyst appears, we're likely going to see a bearish correction.
Potentially dipping back down toward the $9.62 range in the coming days as that buyer exhaustion fully sets in.
Yeah, exactly.
So the short-term technicals are flashing warning signs of a pullback, but the long-term institutional support floors haven't broken yet. We are at a pivotal crossroads, which means it is time we put all of our cards on the table.
Time for the ultimate debate.
We need to lay out the ultimate bull case versus the bear case for Navitas Semiconductor. Let's start with the optimists. The bull case here is anchored to a completely undeniable generational shift in technology.
It's a massive market.
First, from a structural standpoint, the company is completely debt-free with over $236 million in cash. In a macroeconomic environment where high interest rates are bankrupting over-leveraged startups, having zero debt is an absolute superpower.
It is the ultimate luxury. It buys them the one resource a transitioning company needs more than anything else.
Exactly. And crucially, they are not attempting to conquer this new market in isolation. They have already secured major global distribution and manufacturing partnerships with heavyweights like Avnet and GlobalFoundries.
Which is huge for scaling up.
But the absolute crown jewel of the bull case, the reason the stock surged in the first place, is their direct inclusion in NVIDIA's 800-volt AI ecosystem. And we need to understand why this matters. This isn't just corporate synergy or buzzword bingo.
Not at all.
Artificial intelligence data centers run incredibly hot, and they require an unfathomable amount of raw power. Navitas is pioneering gallium nitride and silicon carbide technologies.
Commonly known as GaN and SiC.
Right. And here is why that matters. Traditional silicon chips leak energy in the form of heat when you push high voltages through them. Think of standard silicon like a rusty, leaky pipe. If you push 800 volts of water pressure through it, it bursts, or in a data center's case, it melts down.
That's a great analogy.
Gallium nitride, on the other hand, acts like a high-pressure industrial leak-proof valve. It handles heat and high power with extreme efficiency.
It's game-changing material science.
So if the 2026 ramp-up of AI server racks and ultra-fast charging electric vehicles relies on these GaN and SiC materials, and Navitas successfully captures that transition, you are looking at a fundamental goldmine.
That is the utopian vision, yes. If they become the dominant valve maker for the AI revolution, the current valuation will look incredibly cheap in hindsight. But as an objective investor, you must weigh that utopian vision against the gravity of the bear case, and the bear case is formidable.
Let's hear it.
First and foremost is the extreme valuation we discussed earlier. Paying 20 times the sector median for a company that is currently losing money is a precarious game of musical chairs.
Very risky.
Second, you cannot just hand-wave away a 45% year-over-year revenue decline. The brutal reality of a pivot is that their old mobile business is currently bleeding out much faster than their new data center business is generating cash.
And then, of course, you have to factor in the psychology of the leadership team.
Precisely. The aggressive liquidation of shares by the executives in early 2026 implies a profound lack of confidence in the immediate future. If the people designing the blueprints for the AI skyscraper are selling their own stakes in the project, retail investors need to ask themselves why.
That is a very tough pill to swallow.
Finally, there is the ever-present threat of dilution. You mentioned their cash pile, but building cutting-edge hardware for the world's largest data centers is a brutally capital-intensive business.
So they might run out of that $236 million.
Exactly. There is a very high probability that Navitas will need to issue more shares and raise additional equity in the future to keep the lights on. If they do that, the value of every single share you purchase today gets immediately diluted.
So what does this all mean? We have a fascinating contradiction. On one hand, you have a debt-free company pioneering highly efficient tech tied directly to the unstoppable momentum of NVIDIA.
Yep.
On the other hand, they are bleeding revenue, trading at an astronomical premium, and the executives are cashing out millions. How does a listener reconcile these two completely opposing realities?
You reconcile it by recognizing that Navitas Semiconductor is the ultimate battleground stock. It is the purest possible distillation of the current artificial intelligence market cycle.
High risk, high reward.
Exactly. If you were looking at this from a short-term trading perspective, virtually all the metrics, the technical indicators, the RSI exhaustion, the analyst targets, and the insider flow point to a necessary correction. The speculative air needs to be let out of the balloon.
Okay, but what about the long term?
From a medium to long-term perspective, their survival and potential exponential growth hinge entirely on the flawless execution of this Navitas 2.0 strategy.
And the ultimate stress test for that strategy is arriving very soon. The next major catalyst, the definitive moment where management is forced to open the books and show their hand to the entire market, is the Q1 2026 earnings report.
Which is scheduled to drop on May 4th, 2026.
That singular report will peel back the curtain. It will reveal exactly how fast the new AI data center revenue is actually growing, and crucially, exactly how much of their war chest they are burning through to achieve that growth.
That earnings call will be the absolute moment of truth for the stock. It will objectively clarify whether tearing down the duplex was a stroke of visionary genius or a fatal misallocation of capital. And this raises an important question.
It really does, because when a company fundamentally pivots its entire identity to chase the AI boon overnight, you have to look deeply at your own portfolio and ask yourself, are you investing your hard-earned capital into a solid, mechanically sound business? Or are you just paying a 40 times premium for a really, really good story?
And if the very executives who wrote that story are currently busy cashing out their shares, should you really be the one buying them?
We will leave you to ponder that. And hey, if you're watching this deep dive on YouTube, make sure to like the video, subscribe to our channel, and leave your own feedback and analysis in the comments below. We want to know if you are buying the AI narrative or staying far away from the value trap.